Well, the other big headline that we're tracking this morning is Accenture cutting its guidance. It reported a flat revenue growth, but the important part is it cut its fiscal 2024 growth guidance to 1 to 3% from 2 to 5% earlier. What is the read-through for Indian IT companies? Manik Taneja, the Executive Director, IT Services at Axis Capital, is joining us now. Manik, hi, good morning, and thank you for taking the time out and speaking to us. You know, IT stocks in any case have been underperforming this market, and now here comes Accenture and cuts the guidance. What do you think the read-through could be for the top-tier IT companies?
So I would, first of all, thank you for having me on the show. And more than the reset in terms of numbers, I would say the qualitative commentary is more important. So if you realize over the course of last 3 or 4 months, there has been excitement building in Indian IT services companies that after the moderation in growth that you saw over the course of last 18-21 months, things could start to look up in calendar year 24/FY25 as Fed cuts rates, customers get much more confident, customers start to essentially spend, etc., etc. And because of which you have seen that even IT services companies have delivered positive returns. And also in the backdrop that NASDAQ has been doing extremely well. Now, what Accenture commented in their call last evening is the fact that while calendar year 24 budgets have got frozen, there is still pressure on short-term discretionary spending, and which is essentially a continuation of what has been in play through a better part of calendar year 23. Now, given the expectations from the street / investors has been that things will start to look up from April, May, June itself, I would presume that this will drive further cut in terms of growth expectations for FY25 when companies report in mid-April.
All right. Hi, Manik. Good morning and good to see you. And, talking about the call yesterday, Accenture, they highlighted that short-cycle discretionary projects could take a bit of a knock. There were certain companies, I'm reading various brokerage reports, where they were factoring in some recovery in the short-cycle discretionary spends. Now that gets pulled back, right? So I wanted to understand who gets hit harder and who is better placed.
So, see, from a near-term stock standpoint, just like the excitement started to get built up across names, similarly, some of this disappointment will also percolate to almost everyone in the sector. There were companies like Wipro who are talking about some recovery in terms of discretionary spending in the near term, although their quarterly guidance for JFM or Q4 FY24 did not reflect that optimism. So this will possibly be a sort of a dampener for the likes of Infosys, Wipro, and while I would say that it will essentially have negative ramifications for almost everyone in the sector.
Got it.
Manik, hi, good morning. And the thing is that, IT stocks, yes, we've seen a correction with the market fall in the last 3-4 weeks. But if you go back and see how the market rewarded IT stocks at the end of the previous quarter, at the end of Q3, there was a massive rally without any huge uptick in numbers or without any breakthrough management commentary. But the market was really bidding up IT. Some of that has corrected, but not all of it. In fact, not even half of that rally has been corrected in the last 4 weeks. So just purely in terms of valuations and market positioning, do you see immediate, at least knee-jerk downside because of what Accenture has said, and now we're running into the next event, which is Q4 earnings? And give us your stock preferences, stock calls as well. What do you like? What are you avoiding? What's your overall sector stance?
Some the point that you made in terms of the stocks doing extremely well post Q3 numbers, and still only some part of that has got corrected in the recent weeks. I would say a lot of that excitement is to do with what's happening broadly in terms of global markets. So NASDAQ is making new highs. Even US as well as European indexes are doing extremely well. So some of that essentially is extending to Indian IT as well. From a number standpoint or from an outlook standpoint, I would presume that the guidance that the likes of an Infosys and HCL Tech will issue amongst the larger companies may disappoint street expectations. So we're looking at the street expectations being in excess of 8% plus for Infosys in FY25, with the expectation that Q1 FY25 ends up being very strong because Infosys had significant deal wins through the course of FY24. I would presume, given the backdrop, even Infosys guidance might disappoint when they report on April 18, although that might be cushioned by a potential buyback announcement given the capital allocation policy that they have.
Manik, what's the number? Manik, sorry to come in over here. As of now, I mean, what is the number that you were working with, let's say, till yesterday on the Infi guidance for FY25? And are you going to scale that down because of what Accenture has said?
Sure. So from a estimate standpoint, today our growth expectations for FY25 are about 6.5% growth for FY25. While, as I said, Street essentially is in excess of 8% plus. And the number that we published in terms of what Infosys could guide for FY25 is a range of 3.5 to 6.5%. Although with what we've heard from Accenture, I would presume that there could be downside to those expectations. So that's from an Infosys standpoint. With regards to our sector positioning, we have, so the only buy-rated stock for us in the large cap universe essentially is Tech Mahindra. And even Tech Mahindra has struggled through FY24, but we are looking beyond the near-term weakness in case of in case of Tech Mahindra, given the fact that that's the only large cap name which has the potential to deliver about a 15 to 18% EPS CAGR, once again, as I said, over the medium term, given significant possibility of improvement from a margin standpoint, from an operation standpoint. So that alone can be a significant driver of earnings growth for the name over a 3-4 year period. And that's the reason for preferring that name. Amongst the mid cap names, Zensar is a buy for us. We have sell/reduce across most of the other tier 2 coverage universe.
I just had one short question quickly, if we can squeeze this in, on generative AI, because Accenture did mention that spends for generative AI have gone up, projects have picked up as well. Would you extrapolate that into better business for the top tier players here? And if yes, which ones would benefit the most?
I would say right now, from a even when you look at Accenture size and the revenue contribution that generative AI that they are calling out for generative AI, that's a fraction of their overall business. Just like when cloud became the most important buzzword, everybody wanted to call out the proportion of the business coming in from cloud. Similarly, I would say for IT services companies, now people will start calling out the mix of their generative AI related business. But in the initial period, the Gen AI spending will not be a significant driver for services companies. It could be a bigger driver of growth for hyperscalers and software companies.
Okay. All right. We'll let you go on that note. Thanks a lot for joining in and giving us your quick thoughts on Accenture cutting their guidance and what this could mean for top tier IT companies.